Good late afternoon. What is it? It's late morning? Yeah, I guess it's late morning. So 11:45. Hope you're all doing well. The markets are doing a lot better than they were doing yesterday, and probably for obvious reasons. We'll get into some of those. They may not be so obvious to some of you, but in my book, it's kind of like the writing is on the wall and all you have to do is look up and you can read it. So we'll talk a little bit about that. But the news this morning, pre-market open, was the initial unemployment claims number. That really didn't do a whole lot. Initial unemployment for the week ago came in at 1.48 million. That was 60,000 lower than the previous week's initial unemployment claims number, which is good, but still greater than expectations. I think the expectations were for an estimate of about 1.32 million initial unemployment claims numbers. So we're going in the right direction, not fast enough. And I got a couple questions there. Tom's asking, are we seeing you live now or is this a replay? I hope it's live, Tom. So it's Thursday. It's June 25th. If anybody is watching something other than that, or if you're watching me and you just heard me, let me know. But I hope I'm live. I feel alive. The other obviously important number we talk a lot about here on Thursdays is the continuing unemployment claims numbers, and continuing is, to me, probably more important than initial unemployment claims. That being said, the reason is initial unemployment claims are going to continue to show a backup, and so I don't expect them to drop below 1 million for at least a few weeks. And if they do, then that's a very good sign. But what's more important, I think, is to keep an eye on the continuing claims numbers, because that speaks to, are people going back to work? Are they, are jobs coming back online, and are people getting off unemployment? That speaks to a lot of different things. And because we have another, I think, the end of July before the extra stimulus money runs out, and that's going to, I think, force a lot of people to go back to work if they do have jobs available to them, probably, hopefully, their old jobs. So continuing claims numbers are really important. They came in at 19,522,000. That's down slightly from the week before. And these statistics are 2 weeks, technically 3 weeks ago. And the initial unemployment claims really are a week prior. So there's a bit of a lag between the continuing and the initial claims. There's a week lag between those two, and there's a 3-week lag between continuing that we get, and then there's a week lag between what we see, for example, this morning, and the numbers that were produced were for a week prior. So it doesn't matter. The headline number is what matters. Continuing unemployment claims, 19,522,000. The estimate was for 20, so it's down below the estimate, and the trend is down a little bit, which is really good. It's great to see people going back to work, so that's very important. That trend is something that I'm sure Labor Department, I'm sure the administration, and certainly investors are watching. Because what's the problem now? The problem now, and the sell-off yesterday was predicated on, are cities going to start to lock down again? Are things going to get shut down? We're just getting to phase 2 and phase 3 in some cities and places, and is that going to get reversed because of the spikes we're seeing in certain states? Yes, it probably will impact the market to some degree. We saw yesterday what that might look like. But here we are today, opened down on the day, but really uneventfully so, in my opinion, and pretty much came back very quickly. So what does that mean? It means that investors are doing what investors do. They're anticipating yes, we knew this could happen, and oh boy, it's happening. So you sort of sell that, and then next thing you know, so wait a second, we've been through this, we understand what's going to happen, and if everyone gets their act together and people wear masks, and maybe we don't see the spread farther and faster, then we will arrest this trend, and things will get back to opening up again. So investors are already discounting what they're seeing. We see that today. So what does that say? What does that tell you? It should tell you, and the handwriting on the wall that I was speaking of is, we have the playbook for this. We've seen this. Investors already reacted to what happened in the initial lockdown. Okay. We came off of the lows. Anticipation was we were going to get to the other side. The market was going to get to the other side, and boy, did it ever. Okay. Its recovery shape was clearly a V with an emphasis on the rocket higher. So they're also, investors that is, are also anticipating a V recovery in the economy. Are we going to get one? I'm not so sure about that, but that's the anticipation. And as things start to open up, investors are right. We're looking at people getting back to work. We're looking at restaurants and other service businesses opening, which is a real positive, especially for all the unemployed. So yeah, all good. And that's what the market has been anticipating. And then all of a sudden we see this spike, and we get a few investors get nervous. By the way, there wasn't substantial volume yesterday. The volume was a little bit more than the last few days, but it was certainly not compelling in terms of showing panic in any way, shape, or form. The NASDAQ volume, by the way, was down a little bit from previous few days. So there was no panic in the NASDAQ composite. Yes, it was down over 2%, but again, not on high volume. None of the indices were down on excessive volume, just slightly above trend. Slightly. So again, that continues to be a positive for the market, continues to be a positive for the bull market, that is. And until we see that change and some other metrics change, we got to go with the trend, and the trend is still up. So far, so good for the market. Durable goods orders came back today. Now, we know we're going to see these bounces off of the haircut that all of these metrics took. Durable goods orders up 15.8%. Imports were down 1.2%. That's not so bad. Exports were down 5.8%. That's not good. But the trend is getting better for both of those. So not bad statistics at all. And again, the market seems to have anticipated that this is what we were going to do. We were going to tumble, hit some nadir, and then start to bounce. Have we hit the nadir in terms of GDP growth? Well, we'll find out eventually. I don't think we've hit anywhere near the lows of where GDP is going to be. And I think second quarter is going to be perhaps a bit of a stunner. And if it ends up being better, and some of the range is all over the place, and it's changing now as we speak. I'm seeing a lot of analysts revising their expectations for Q2 GDP growth. And now I see it anywhere from down 10% to still down 40. A couple of analysts have it down 40%. I think that number is far too negative, and yet again could be. So this is the worry that's out there. We know the wall of worry. We know what all of the blocks in the wall of worries are that investors have traversed. There's the virus. There's increasing spikes. There is the unemployment rate. There is the election upcoming. There's the prospect for increased a flood of bankruptcies as things start to open up, and folks who do open find that they don't have the business because of social distancing and for other reasons, because they've expended their capital trying to keep the business while it was locked down, and we may see a flood of bankruptcies there. So that's built in. So investors know where these problems are. And as far as the protests, we see them on TV, and that's not really impacting the market. So far, so good, climbing the wall of worry. Unless any of those bricks, those large bricks, fall out and create some really negative headlines, they remain scalable. And so far, so good. So pretty much where we are today. As I speak, the Dow is down only 16 points. The VIX is up just a little bit. And, the VIX didn't power through any kind of resistance yesterday. A lot of folks thought it was going to spike up to 40 range and higher. It didn't. So again, yes, volatility increased. Obviously, there was obviously put buying as investors get defensive and or investors who look to play the market from the downside buy puts. But we didn't see put premiums explode, which is what will push the VIX higher. Didn't see that yesterday. So again, looked like just profit taking to me on news. That's all. So I wasn't overly impacted negatively by what happened yesterday. In fact, an article I wrote yesterday for my Total Wealth folks, I said basically, buy any dips right now because we know what the wall of worry is. We know how investors have climbed it. We know what every brick in that wall looks like, and we know how they're being addressed. We're not, the Federal Reserve is not going to stop. Yes, their balance sheet actually contracted by 1% in the last, I guess, week and a half, maybe going on 2 weeks now. So slight contraction. Does that bode a trend? No, absolutely not. Federal Reserve knows that it has to continue doing whatever it has to do, and it's not going to stop. If they have a lull, if markets are going up because investors are sanguine and more optimistic, and they see an opportunity to maybe pull back a little bit, or perhaps on some maturing issues in their balance sheet, maybe not roll them over. Yeah, they should do that. It doesn't mean they're going to stop any of the programs. Believe me, they're only getting going. They're going to do whatever they have to do. That's the underpinning pillar that's going to keep the stock market up. Fiscal responsibility being what it's going to be. I know that word responsible doesn't really, it's kind of oxymoron, fiscal responsibility, but the prospect of the legislature of Congress not providing additional stimulus when it's needed, and it's going to be needed soon enough, because when the extra unemployment benefits run out, we're going to see some real problems, and they're going to have to. There's going to have to be another stimulus package, and it may be helicopter money. It may be helicopter money and an infrastructure bill. So that remains to be seen. But we haven't seen the last of fiscal stimulus. So we got central bank stimulus, we've got fiscal stimulus out there, and more probably coming. And again, those are the things that move markets higher. So far, so good. I don't see anything impacting any of those metrics right now in any way, shape, or form. In fact, I think volatility is going to remain elevated, but we actually sold some VIX puts yesterday. Assuming that the volatility is going to stay relatively high. It doesn't mean we're going to see really negative markets because volatility, I believe, is going to remain elevated. It just means that we're going to have days like we had yesterday. We're going to have days where we move up and down, and that's going to keep the VIX, I believe, north of 30. If VIX comes down to the upper 20s, that wouldn't surprise me. If we get a good long rally, it certainly could. But I still believe that for the rest of the summer, we're going to see elevated volatility throughout the summer and certainly into the fall. So there we go. We got a bunch of questions here. Then I want to talk a little bit about what else could possibly impact the market rally. And we'll go over a couple of those things that are out there. An additional couple of bricks that in that wall of worry that the market has climbed, but aren't really focused on, but they're in there, and some investors are aware of them, but a lot of investors aren't. So we're going to talk about those real quick. Let me see what kind of questions, if I have. Hopefully I didn't drop too many questions yet, but let's see where we go. I'm going to come from the bottom before they disappear. George, what's the best indicator of volatility? Best indicator, George, is the VIX. That's the measure of put and call premiums based on options on the S&P 500. So if you're looking at the S&P 500 as the benchmark of the stock market, which is it is the institutional benchmark of what the stock market is, and you want to hedge your portfolio, which maybe mimics the S&P, and or you just want to speculate on the S&P going higher or S&P going lower, you can buy an ETF like SPY, or you can buy options. You can buy put and call options on the SPX, on the actual index. And it's the measure of what investors are paying for those puts and calls on the front month of options on S&P 500 that we then extract from that. What are they saying? So if you're willing to pay a lot for, say, puts, there's something implied in there, and based on the price you pay. What is implied is your version of what volatility is, whether you realize it or not. You're paying up for something. It's like you're scared. I want to buy more puts. I'm scared the market can go down. So there's a way to extract mathematically what investors in sum total are paying for puts and calls, and assume if they're paying a lot, what they're assuming the volatility might be. Now that investors don't think, they don't assume a volatility, they just assume pricing, and they assume losses, and they reflect that by what they're willing to pay, and in this example, for put protection. So when premiums go up on puts, you can calculate actually how much that's gone up, how much the premiums have gone up, and for calls, and for those front month options on S&P, and that's how you extract the VIX. So the higher the VIX goes, the more volatility investors expect. Okay, that's all it means. That's what the VIX, and then it is the standard, really the metric that everybody watches, and it's also known as the fear index. So that's the one you want to keep an eye on, because that's the one that everyone talks about. Certainly in the financial press, VIX is front and center, has been for some time. Ruby, is IWM on its way down for good with bankrupt companies? Good question. IWM has underperformed, and yesterday, the IWM is the Russell, and yesterday it got hit a lot harder, obviously, than the other. And every time, and the markets, when they've gone up, the Russell has been trying to catch up, and it's had good performance on up days, but on down days, it gets hit a lot harder. Yesterday, for example, the Dow was down 2.72%, S&P down 2.59%, NASDAQ comp down 2.19%, and the Russell down 3.45%. So we saw that, and the big sell-off couple of weeks ago, June 11th, as an FYI, the Russell got hit the hardest there too, well over 7%. So is the Russell going to roll over? It doesn't look good right now. So I wouldn't be playing the Russell from the upside. I still like the market from the upside, but that doesn't mean you can't like one market and benchmark and not another. It doesn't mean you can't buy one and short one. You can create a pairs trade like that. And it might be interesting to look at a pairs trade with, say, the Russell, being short the Russell, or IWM, the ETF that represents the Russell 2000, and long the NASDAQ composite, or long QQQs, the NASDAQ 100. So there's a pairs trade for you there, which is not a bad way to go. So that's as far as IWM and the bankruptcies. Yeah, the Russell is going to be at risk for rolling over as we head into the summer, and certainly as we come out of the quarter and we get a view of earnings for the second quarter. As we're coming out of the quarter and into the third quarter, I think we may see some bankruptcies start to percolate there. They're already percolating. There are already some out there. And we know that there's some headline ones, obviously. So yes, IWM, I think be careful on that. Tom, AXP, do you see a comeback over 105? Some of the financials have not done as well as they probably as investors thought they would. I have been somewhat negative on the financials. I think you guys know that, in spite of the fact that we bought Wells Fargo yesterday on the kind of bought it on the low side, which I really like. Well, I'll come back to that in a minute. But American Express, you're asking about AXP. That's American Express. It doesn't look good. It looks kind of rolls over, and to me, it looks. I think it could get down to 90, below 10. Can it get back over 105? I think it's going to be a struggle. I think it's the only way it's going to get back over 105 I see is if the earnings come out good. So I'd be a little apprehensive there and holding that based on earnings below 90. There's some good support there. It looks a little dicey. So that's my opinion of American Express. Ruby's asking, why don't our big companies train people out of work? That's an excellent question. I wish I had the answer to that. I don't know why they don't. They should be. They should be investing in the labor force. It's to their benefit. It's to the country's benefit, and to the benefit of their profitability. So it's a good question, Ruby. I don't know why. Safe to buy your dividend stock recommendations again? Yes. Yeah. Again, Ruby was asking about some dividend stocks we've talked about here, and also some, I believe, maybe Ruby that recommended in Money Map Report, and also in my free writing, The Total Wealth. I talk about dividend stocks there. I'm going to probably put a few more out next week for you guys. Yeah, the dividend stocks that I like are companies that I think are solid, and they have, again, reasonable payout ratios on the dividend. That's one of the primary things I look at. Again, I'll come back to Wells Fargo towards the end of this, because I do want to address it, because I got a lot of questions about Wells Fargo, and there's been some press lately about banks cutting dividends. So I'll come to that at the end. Sergio, afternoon, John. Good afternoon to you, Sergio. Would like to get your thoughts on HD, of course. As far as HD goes, I have to say that this is a long-term hold. How can you not like this? I've always liked HD, Home Depot, better than Lowe's. I think the stock has performed better. I just think it's just a great company. The stock has performed super well coming off of its lows. I mean, what a buy it was down there in like the 140 range, somewhere down there. It's now 243. This is a spectacular move up. So yeah, I think, you hold on to that. It's got a almost 2.5% dividend. So yes, there's no reason to sell Home Depot. If it dips, it's maybe an opportunity to buy some more. But if it dips and you don't want to buy more, for those of you who don't own it, at some point, this stock could, if the market takes pause, the stock could come down maybe 210. I think it would be a buying opportunity there, but it's a long-term hold. Even if you buy it there and it comes down lower, if I bought it at say 210 and I came down lower, I would add to my position, because it's a long-term hold. Tom, I like the dips. Good time to buy out short positions on long vertical calls. Yes, I agree. RL is CCL. Oh boy, that's a great question. When does a new junk bond status get priced into a stock? Well, it's already priced in. I believe that, I don't know, but I have to believe that the rating agencies, if the paper on CCL on Carnival Cruise Lines wasn't already junk, I have to believe that it's junk now. And if it's not, I'd be absolutely surprised. So let's just assume it's junk. So it's already priced in. If you're looking at the stock, any downgrades are going to get priced in quickly to the stock. And a lot of times the debt downgrades, you don't see a big dramatic sell-off in the stock and the equity, because a ratings agency knocks the debt down. Because a lot of times they only knock it down one level, and they may have some commentary on there on watch or stable. They may knock it down and then call it stable. But as far as Carnival goes, let's assume it's junk, because that's what their debt has to be, because they have no revenues coming in. How are they able to service their debt? We don't know when the cruise lines are going to be able to sail again. So we've got lots of issues with cruise lines. Assume the debt is junk already, so it's already priced in. And as far as the stock goes, again, it's already priced in. So now, if you're looking at the equity as some kind of play, a speculative play, I presume, then just forget about the bonds. That's already priced in. Just look at the equity and make your play based on what you see in the stock price. Peter's asking, stuck in 401k mutuals, anything to look for in a bear market? I presume, Peter, you're asking, are there any plays you can make in your with mutual funds, or to get out of the mutual funds? Give me a little clarity, a little color on that, if you don't mind, Peter, and I'll try and answer that better for you. The GTN, what's a good price to hop on? And I'm going to take a look at some of the stocks you guys want me to look at graphically. So shoot me over a couple of names, and we'll take a look at those as we review the market and where we are, the major benchmarks after the sell-off. But while I'm thinking of that, I just want to remind you all that the other day I talked about not being greedy, and I know we talked about leveraged ETFs. And I think there was a triple Q leveraged ETF that we talked about, and I pointed out that if you get a couple days run, take your money. And I hope whoever was out there, you guys were looking at this, and some of you were in some of these leverage, and you had a nice little run. So hopefully you took your profits, because you see you have a day like yesterday, and you give up things pretty quickly. So again, on the leveraged ETFs, whether you're playing from the long side or the short side, if they're leveraged, get your run, make your profit, sit back, and bring the register. Don't. Those are not long-term holds. So again, I'm going to keep reiterating that kind of advice. Great technology at GTN. This stock is hanging in there. I think it's going to come down, and well, it could come down, I would say, to maybe 12. It's at 13.47 now, thereabouts. It could come down a little bit, but it seems to be hanging in there. And again, part of the rolling over that we're seeing in a lot of issues is because we're seeing the markets sort of slow down here, and investors wondering, have we reached the top, or how much ammunition is there out there to lift stocks higher? And that's part of what we'll talk about in a minute. Just want to grab a couple more questions, a couple more stocks, and we'll come back. But that's what I want to talk about what's going to drive the markets another leg higher. And is there enough ammunition out there to do that? And if there isn't, what's going to happen? So I'm going to write down a couple of the names. Matt's asking NTAP, NTP, NPTN, NPTN, and we'll. Peter's asking about TBBK. So anybody else to shoot a couple of questions over some stocks while I'm just finishing up talking about what is out there that's in the wall of worry that we've gotten over, that investors aren't really focused on. We talked about the big things. Everybody knows what the big things are, but a couple of little things are something that's off the radar. It's out there, but it's not really mainstream. There's a lot of rebalancing likely to be done at the end of this quarter. A lot of institutions, a lot of pension funds, they balance their portfolios based on models, and when they're over perhaps weighted in equities, because equities have risen so much, for those who are in place and didn't sell, and they've got their portfolio intact, and they've seen this very large rise in equities, they're going to look at bonds and say, well, now bonds are underpriced relative to equities, and our equity portfolio side seems to be getting more fully priced. They're going to rebalance. And this happens across the board every quarter. Sometimes it happens to a small degree. Sometimes it happens to a large degree. Sometimes, even if it's a large degree, which appears to be the case for this quarter coming up, for the end of this quarter, which is just around the corner here. The numbers range from about 50 billion to over 100 billion. Now, that's what sounds like a lot, but if done systematically, that's not a lot. So in other words, let's use the high-end number. If there's over $100 billion in excess of weighting in your portfolio of $100 billion, we'll talk about the pension portfolios out there. If you have an excess weighting because the stocks in your portfolio have risen so much, and you want to take some profits and you want to allocate to a cheaper side of the equity structure, which would be, the capital structure, which would be bonds, then you're going to sell some equities and buy bonds. Okay, so $100 billion collectively, and the number could be larger than that, but that's just a range of numbers I've read. If it's done over a few days or a week, it doesn't have to jolt the market. If it's done fairly quickly, it could jolt the market. If it's done because the market starts to come down right into the end of the quarter, and these funds want to book their profits and hold on to the profits that they have, their selling could accentuate a sell-off going into the end of the quarter. So we could see some kind of reverse window dressing, where the impact of that selling and the buying of bonds shifts the market. So that's something to be aware of. It could pass uneventfully, or it could exacerbate any selling that the market sees. As far as, and I'm going to just take a couple more questions and then I go back to, but I just don't want to lose your questions as you guys put them up there, because I do want to address these stocks for you. We got FSTL, we got BRKB. Silver SLV, we got the Silver Trust there. and NL. I think that's an NL, anonymous. I believe it's NL. And okay, John, you meant FSLY. Okay, FSLY. Got it. Chris is asking, okay, Chris, that's a great question. I'm asking about stops on options. What percentage? Okay, I'll come to that afterwards. So let me just quickly kind of round up what I wanted to say about what are some of the other bricks in the wall of worry that has been climbed. Retail, we talked about retail. Retail has led the market higher off the lows. Jolly good. I'm all for it. The problem with retail is if retail has exhausted their buying power and they put an awful lot of money into the market, if they're kind of sitting out now, wait to see if their market's going to go higher before they chase stocks again, or they're just on the fence for the time being, then we don't have the ammunition coming into the market, firing at bids, taking stocks higher. If we don't have that, then there's no reason towards the end of the quarter for big institutions to have to chase up those stocks, because if they're not in them, they're not going to be the ones to chase them up. They're going to try and buy them again for window dressing for those who've missed them. But there could be this lull, and they could start really now and certainly the rest of the week. And it could be just the question and into the early next week of, will the market come down, especially after yesterday? So if you're an institutional investor and you need to buy something to window dress because you didn't own some of these big high flyers, and you want to prove that you did own them. So are you going to chase them? Well, not if you look at a day like yesterday and say, well, maybe I can get them a little lower, or maybe I'll be happy if by the time we close out the quarter, then we're going to see some additional selling. So that's really what's there. It's coming to a close very quickly, but days like what happened yesterday, if we have, say, that happen tomorrow, that could lead to some dramatic selling. And on top of that, if you've got that rebalancing thing that starts early, that could lead and add more weight to the sell-off. I don't see it happening like this. I think those are mechanical issues that can happen, but right now there's no reason, as long as the market's holding up today. If we were down really severely today, I would think that tomorrow could be pretty ugly, but we're not. We're up today. However we end the day, investors have watched all day and thought, well, this is not bad. There was no additional momentum to the downside based on yesterday's action. So that bodes well. So far, so good. But I just want you to be aware of what's out there. And retail is, again, leading the market. And retail right now doesn't have a reason to sell. If they do, it's because they want to take, first of all, the profits that they have. And then if the market continues down, they might start to think, well, okay, I don't want to see any losses with my new capital in the market, so let me just get out. And we could then see a little cascade of selling there. Hasn't happened. So far, retail has really been stalwart and not panicked on any down moves. That happen, and the reason we see that is we don't see the volume spike on down moves. So far, so good. So there we are. Let's go take a look at some stocks. And Peter's asking, okay, Helga, I'm going to put down NK also. And we'll take a look at that right now. Okay, George, Tesla. Always like to look at Tesla I think it's just a fun company to watch for sure. And Ken, you want to talk about COP? ConocoPhillips. Okay, and Peter, lastly, I'm going to take this question, and then we're going to switch over to screen share. Peter's asking, do you follow what hedge funds are doing? They have a large impact on the market. Yes, I do follow what some funds are doing. It's not in a macro sense that I want to know whether they're not long, net short, or what. I'd like to look and see what they're getting in and out of, and that information is delayed a little bit. So you're a little bit behind the curve. It's lagging information, but I want to get the trend of what they're doing, because a lot of hedge funds move in a herd. These guys know what each other are doing. They got their traders are keeping an eye on what one another are doing. Wall Street, listen, if somebody has a good idea, everyone else is going to try and glom onto that idea. So they're always trying to pick off each other's ideas. And ipso facto, if there's a couple of large buy orders from some funds and other funds find out about it, they're going to piggyback that or try and get in ahead. Similarly, on the downside, if a couple of funds who have made a bunch of money on some moves are exiting those moves, then other investors, other hedge funds are going to look at that. And if they've got a position, again, we have that kind of concentration in a lot of hedge funds, those guys are going to try and sell too, because again, you don't want to have your competitor sell a huge position to take a profit ahead of you, because then that's going to leave you probably with the stock lower, and then you want to get out and you're going to drive it down. It doesn't work that way. So there's a lot of picking off of ideas, a lot of picking off and following one another in and out of stocks. I like to keep an eye on that. I'm looking for momentum ideas. That's what I do with keeping an eye on hedge funds. And I talk to some guys and kind of get the skinny, because I'm not competing against them anymore. I'm not doing what they're doing. So we just talk shop, and I get a lot of insight as to what the thinking is in some of the shops. All right, Julian, you're more than welcome. So let's have a quick screen share and take a look at some of your stocks. All right, we should be sharing. So let's go take a look at bar charts. First up is, and I had this up there on purpose, so when I knew when I opened up this window, this was going to be up. I just want you guys to take a look at, this is the Leverage Ultra Pro QQQ. So I know, you should know that the QQQ is the ETF that tracks the NASDAQ 100. The TQQQ is a leveraged version of that. So it's very bullish. And if you think the NASDAQ 100 is going to go up, you can buy QQQ ETF shares, or you can buy TQQQ and you can get a better bounce if the market's moving up. And here's the example I want to give. You had this nice ride. We talked about this the other day for some of you guys who are in these leveraged upside ETFs, which I recommend you day trade with. And then, you had a really great, this was your day to sell because you had a nice gap. I know it looks like, okay, we gapped open, we can go higher. We always talk about gaps here, and gaps get filled. So again, if you had a nice run on it for a few days, that's the time to take your profits. You got to set a mark for yourselves on these leverage funds. Set a mark that you're happy with. If it goes another day or two higher, so what? Okay, just make sure you ring the cash register, because you get a day like yesterday and you gave up pretty much everything. All right, so I will say this again and again and again. The leveraged ETFs are great trading vehicles. Love them. Don't be greedy with them. They're short-term moves, and get out. So here's ugliness. And then if you're in today, doesn't matter what the market does at the end of the day. You've already given back most of what you had hoped to ring the register with. So again, don't be greedy. Ring the register. All right, NPTN. I think Matt was asking about NPTN. Neophotonics. I don't know the stock, so we'll just take a look at it blindly. And again, it's nice to know the companies, but I've been in the business so long. A lot of times you can look at the technicals and I can tell you the psychology of what traders are thinking, even if I don't know specifically what the company does in detail. You do this long enough, you have a pretty good understanding of what's more important is, in the short term, trading, buying or selling or taking a profit or limiting a loss, is knowing what the stock's going to do. It's always important to know what the company does and how well it does it when you're holding a position for a long time or shorting something. But in this case, I don't have a lot of knowledge on this company, but I will say, obviously, it was making a move up prior to the COVID sell down, and made a move back up. Looks like a nice double top that it and made here, and then broke out very quickly, coming back down. Stock is now below its 20-day, below its 50-day. Had a pretty ugly day yesterday. To me, that looks like a bit of a breakdown. To me, now down here today, this is today's bar. What worries me about a stock like this is you got that double top, and right along here, I would say you need to be a little bit concerned. Let's see if we can get the put a trend line up here just to see where there might be some support. So, it looks like you kind of have kind of where it is right now, where on the lows yesterday, there's some support. And the low yesterday was 812. Stocks at 848 now. Below 812, it looks a little bit dicey. Then again, if the market bears up, it may bounce off of there. It doesn't mean it can't break below there and consolidate, which looks like it's trying to do. I just worry about this dramatic action here when it came down quite dramatically through the 50, through the 200. I don't know what caused that. Matt, that's something for you to address. Why did it do that? What caused that sort of dramatic break? That sort of action worries me. And the stock appears fairly volatile. So again, recovered nicely. I would just be a little cautious in here. TBBK. Oops, wrong one. Computers want to work with me today. Try that again. If I'm a little slower. Raw Bank Corp. Yeah, sorry, folks. The internet is muddling along today. I have to say that this stock looks pretty good. I'm not really happy with the financials. Again, and the reasoning is coming into earnings. We're going to see what kind of loan loss provisions they're going to put aside, and that worries me. I think they could see a little more selling on that. There may be an opportunity. I like to see some selling on that. I'd like to see them really step up and put aside a lot of extra money and be well positioned. And then I think they might be a buy. But right now, I'm not sure about any of the financials. And a lot of them have a very similar pattern to this. So you got this crazy move here, big gap, filled the gap. Now we're down below the 200 again. We're down below the 20 and coming back down. So right now the uptrend is still intact. I think you're okay, but I don't know. Again, if I'd be adding to this, or if I had if I bought somewhere down here, I certainly would be looking to take my profit, because if you bought anywhere down there and you got 100, 75, 50% profit, I say ring the register. If it comes back down low and you still love the stock, then and the company, buy back in a little lower. So just be careful there that you don't give up too much of your profit if you bought lower. If you own it up here, and it's a quality financial, then I'd say give it time. If you've got a longer term horizon, the financials will do well over time. They're just going to struggle for a little while. FSLY. And we often look at the financials here because they are a bellwether, and especially coming into earnings season and coming out of Q2 into Q3. And what I think may happen, which again, I believe it would not surprise me to see a flood of bankruptcies, both personal and business. And that's worrisome. It's worrisome to the financials, to the banks, of course. That's also worrisome as far as the economy goes. It's worrisome as far as unemployment goes. So, wow, what an absolutely crazy ride. I hope you bought this. I think this is you, John. I hope you bought this, because wow, what absolutely stellar ride. All I'll say about this is, don't be greedy. This is I hope you bought it down low, and what a tremendous gain. Congratulations if you did. I don't even know what the company does, but I look at that stock and say, I don't want to give up that kind of gain. And it's when you see a stock move parabolically like that, The thing that worries me is what caused that, unless it's really fundamentally solid news, solid metrics, solid earnings, solid revenue growth, everything's being solid. If it's rumor, if it's based on a product that's or something that hasn't fully been developed and everyone's talking about it, but it's not here yet, then the stock can turn around very quickly, and you'd hate to see a tremendous profit evaporate. So that's my thinking on Fastly. I'm trying to pull it up in Yahoo, but because my internet is so slow, it's not coming up in a timely fashion. I wanted to see what it does and get into a little bit of the metrics for you. But slow as molasses. One more shot. But that's a hell of a ride. Next time you come up with a pick like that, John, let us all know, would you? This is, I'll just have a quick look at Yahoo metrics here, John, and just give you a snapshot of what I see, and for everybody else who's maybe interested in this. And I know a lot of folks will take a look at a stock like this and have watch that kind of a move and think, well, maybe there's a place to short it because it may move too fast for its own good. That happens. Profit margin here, negative. This is a high flyer that kind of scares me. Revenue, 217 million. It loses money, lost 53 million net to common. So it's got a little bit of cash. What I don't like about all of that is, well, I don't like any of that, but worst of all, is the operating cash flow is negative and the levered free cash flow is negative. Not carrying a lot of debt at $31 million, but again, it's just not producing net income, and its EBITDA is negative. So that's a problem. So I'd be very careful based on those metrics of a high flyer like that. So if you have profits, think about taking it. The company operates on the edge of cloud platform for processing, serving, and securing its customers' applications. The edge cloud is a category of infrastructure as a service that enables developers to build secure. Okay, just another cloud company. Okay, there are other better cloud companies. Okay, I've been doing a lot of work and looking into a lot of cloud companies, and there are some really good ones out there, really good ones. But this one, based on the numbers, you're buying a pig with a poke. It's just like, okay, is this going to be one of the winners? Metrics wise, doesn't look like one to me. So be careful out there. BRKB, I believe, is one we got. So I'm not sure this was one. It looks like if it was someone's question, pretty thin and don't have much to say other than it's kind of scary. Silver, SLV Trust, we're going to take a look at that, and we'll have a quick look at gold while we're at it. So the Silver Trust, the iShares, there's been a lot of talk I've picked up on lately that as gold has moved well, silver has underperformed, and I don't see it necessarily as underperforming, but for those who watch silver and gold, the relationship between the two, I've been hearing and reading that silver has underperformed and has some perhaps catching up to do. So that bodes well if you're an SLV. Certainly looks pretty good to me. It had a heck of a good rise. What I do worry about is you have this gap over here, and this stock is just another little gap. That one doesn't bother me so much, except we got some space here. So you had this tremendous move up. This gap, that doesn't bother me because it's so far down below, and we know what had happened on the way down. This bothers me a little bit. It's just very speculative that we would see this kind of move. It's like, let's just jump into this, jump into silver. But so far so good. You saw above the obviously above the 50, the blue line, well, nicely above the 200. So I think you hang on to it. Yeah. I mean, this, to me, you got support around down here in 15 range, 1550, low, maybe even 15. So yeah, stick with it. As far as I'm concerned, I would stick with it if I owned it. Especially if I bought it a lot lower. Now, gold, gold had been on a really nice run, And the question is, can it continue? We've talked about gold for weeks here, and I like gold. I'm not a gold bug. I tell you guys that all the time, but I do like the action in gold, and there's no reason not to be long gold, no reason not to continue to hold GLD. Again, sometimes you want to take profits, fine, take profits if you had a good run on it, but it doesn't mean you can't get back in. Doesn't mean you can't say, okay, I got my profit. And even if it goes a little higher, so what? If you still like it, you revisit it, you've got money in your account because you've rang the register, then get back in. Okay. People are always afraid to chase stocks higher on account of the fact that, well, I got out, I made some money, and then it went higher. So what? It doesn't mean it can't go a lot higher and a lot higher from there. So if you really like something, and gold is one of those examples lately, and longer term, the talk about gold is, why is gold going to continue to rise? Well, central banks are buying gold, and there are a lot of investors who are buying gold as a safe haven because all the money printing that's going on is going to create inflation, and gold will be a store of value, on and on and on. You know the narratives, especially you folks that buy gold and know more about gold than I do. You know all the narratives. So I go by the general narratives, and believe me, I know enough about gold to look at this chart and know what gold is and how people view it, to say, if you own it, keep riding it higher, because it looks like it's got more to go. NL. NL Industries. Okay. Again, I apologize for the slowness of the wow. NL Industries. What I'll say about that is this: a lot of sloppiness. I'm going to go back a little bit further, just on my other chart software here, and NL had a nice run up in a couple of years. It got up to, a couple of years ago. It was up to 14. It came down, and then it got sunk starting back in 19, and it's done a lot of nothing other than trend down. Is it coming back? Based on this chart, looks like it's trying to come back. It's trying to make a move higher. It could have been a long consolidation period for NL Industries, and for those of you who don't know NL Industries, I'm just going to read off Yahoo. Through its subsidiary CompX International, operates the component products industry in the United States, and internationally, the company manufactures, sells mechanical and electrical cabinet locks and other locking mechanisms, including disc tumbler locks, pins, blah, 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 blah. Has a lot of stuff for security. Let's say electronic circuit panels, storage compartments, gas station security. Also offers original equipment and aftermarket stainless steel exhaust headers. So it's in a lot of different businesses. This has been a company that's been around a long time, and has over the years been a pretty good company. It's a small cap company, but it's generally speaking, it's done pretty well. Lately, I haven't looked at it in a long time. As looking at the stats now, for a small cap company, the revenue is 125 mil. It does make money. Made 12.5 million to common. Debt is 500,000, sitting on cash at 133 million. I think if you own it, I'd give it a little ride. I think you can maybe get a little something out of it. I think the stock can, if the stock breaks out, you've got this over here. If the stock breaks out, it's going to have earnings to break out, but you've got this. I'm going to just kind of draw this here. You've got that. And you break up above that, and now you're at really 392, call it $4. You get up to $4 in this stock, and that, first of all, that'd be a pretty nice move from where it is now, from 324. Just have a quick look at the downside. Some of these inexpensive stocks are really fun to play. And again, if the company has solid earnings, it's not just a fly-by company, actually does something, makes something. They're worth a play. So yeah, that's a decent stock, decent company to make a play on. It is small cap, and it's going to be impacted by its earnings in terms of trading. But so far, so good. So as long as you stay in this range and don't break down, this is pretty ugly down here. You see a stock like this drop that much, that's a huge loss. I'd say, you've got some support down here at about $3. So 324 now, maybe worth a shot, but I'd keep a tight look and eye and maybe a mental stop on it. But it's the kind of company that you can maybe get a quick ride out of. Real couple more real quick, and then I want to talk about stops on options because that was a great question. Okay. Another company I do not know. So let's have a look at the stock first. Okay. Just just the first thing you notice, everybody, is if you just now we're just eyeballing the stock. We don't even know what the company does. It's like, okay, what is our interest in this stock? Do we want to buy it? Do you want to sell it? If you own it, do you want to take profits? Do you think there's a place here to short it? Just look at the stock. And the first thing you notice is there's a whole lot of nothing going on here. There's absolutely nothing going on. All right. So this is a cheap stock that's got nothing going on and there's no interest in it. So all of a sudden, what happens? This thing goes through the roof. It comes to life and just goes absolutely bonkers. So let me have a quick look at the metrics. So it makes this move, okay, before it is hit by the coronavirus and comes back down. And even when it comes back down, it doesn't come back down to its lows down here. It sets itself up at a higher level and is coming up from there. So this company, I'm just looking at Yahoo real quick, and I'm looking at the operating margin. Is down negative 113,000%. Return on assets, very negative. Return on equity, negative. Revenue, $59,000. Okay. Yes, big quarterly pop, 320% growth in revenue, but $59,000 in revenue doesn't cut it much for me or anybody. It's got 40 million in cash, 13 million in debt. Operating cash flow negative, levered free cash flow negative. So it's a problem. I haven't even gotten to what the company does yet. The thing that tells me it's moving up like that is the fact that is a huge short position. The short percentage of float is 16.5%. That's monumental on shares outstanding of 98.5 million. Float is is a very stupid 34 million. You have 98 million, 98.5 million shares outstanding, and the float, the amount of shares available out there in the market to actually buy and sell, 34.25 million. And you have 16% of that has been shorted. That's where you get those moves. So if you own it lower and you're up there based on a short, take your profit. Okay, do not pass go. If you own it, down here, $2, $3, $4, and this thing's at 11, you'd be foolish not to take your profit. I don't care if it goes to 20. If you bought it way down a lot lower, take your profit. What does it do? Nant K West, a clinical stage immunotherapy company develops, okay, so we know what it is. All right. It's, trying to buy, cash out on the coronavirus or some other, especially coronavirus, because it's, immunotherapy company. And so that means it's really speaking to COVID. And that's what investors are looking at. Is this going to be the stock that wins the lotto? Good luck with that. Could it? I hope I'm wrong, because that'd be good for everybody, especially if you own it. But it'd also be good for us if they come up with some treatment or vaccine. I look at stocks like this, and I want to take a profit. If it comes back down, maybe I'll take half my profit, and the rest of it is a free trade. And maybe the company can do something. But I'm just apprehensive about these companies that get bid up because investors, and a lot of these are the Robinhood type investors. There's nothing wrong with Robinhood and retail investors going after these companies. Absolutely nothing wrong. But just understand, these folks are really super speculative. They're trying to hit, they're playing the lottery. That's what they're trying to do. And sometimes they create lottery type winnings for themselves by bringing other investors in and talking about these on chat room boards, on Twitter and other places, and other investors jump on board. And next thing you know, it hits the Robin track that tracks what investors are buying at Robinhood. Next thing you know, oh my gosh, there's a name out there. Look at that stock is done. And guess what? You create your own momentum, bringing in other investors. And a lot of times people are selling out at that point. So be careful about NK. If you own it, congratulations. You've had a hell of a run. Tesla, good old Tesla. Yeah, and Tesla is getting old, isn't it? Yeah, I want to say rolling over. But then again, so many times I thought the stock was rolling over, and it did, and only to bounce dramatically. So I have been wrong mostly about Tesla. I stopped shorting it a while ago. I made some money on it, lost money on it, net made a little bit. But I only played a couple times from the long side. Other times I was trying to play it from the short side, got my head handed to me, and so I learned my lesson. Believe me, at some point I want to sell Tesla, simply because I just think there are other car companies that are producing and starting to come out with some really good looking electric vehicles, and the EV market we know is going to grow explosively, period. That's it. It's the future. We know that. Is Tesla going to be the leader? It is the leader right now. Will it continue to be? It's going to come under pressure. So, so far so good. If you own Tesla and you know, and you're a believer in all things Tesla, then I guess you got to go with it. But there's another story for me of like, oh my gosh, what a lot of profits people have in this company that they're banking on. For me, at some point, I'm going to take a whole lot of my profits and then maybe play with some options and see if I can continue to ride it up. But I have limited loss if I'm buying calls, and I know what my risk reward ratios are, and that's something I do with some companies like Tesla, that if I was in it and I wasn't, and I had a heck of a run and I had a ton of profit in this, that's what I would do. I would say at some point, I held my breath. I made a lot of money. I'm still holding my breath. Maybe I just ring the register and go out and buy myself something because I've been so lucky, and then buy calls. And if I lose on the calls, I lose, but I can also win big on the calls if the stock's going to continue higher. So that's one way to play it. Last but not least, we're going to look at Conoco, and then we'll talk about stops on options. So ConocoPhillips, again, to me, are we done? I think you guys know I'm long oil. I still believe we have a ways to go up. I think WTI is going to get to 50, and may take a little bit of time, but it's definitely going to get there. And I think we're going higher at some point within the next probably year, maybe longer. I don't care. I'm patient. I certainly don't mind holding on. Some of the oil companies are great plays. Question is, how many of them are going to be able to maintain their dividend? ConocoPhillips right here looks like it's kind of rolled over. I'd be a little apprehensive because the capital expenditures and outlays for oil companies are so huge, and when oil falls, they cut their capex, they cut their spending, and if they cut enough, they cut into their future earnings potential. So you have that dynamic with some of the big oil companies, especially the explorers. That's what you get. So it's a dicey game. There's your uptrend there. And is it intact still? No, it's broken down. Does that mean it's going to consolidate here and possibly go higher? Yeah, so there's your uptrend. Okay, so you had a very nice move off the bottom, and now you got this breakdown here. And you got some resistance. This is a lot of the oil companies' stocks look like this. Okay. So you've got that. Now you got resistance up there, and you got some support down here. So you got some sideways action here, and that's consolidation. That's a good thing, but it doesn't mean you're out of the woods. So let me just try and draw a quick consolidation channel for you here. And so basically, you got this kind of action here, but you're coming down to the bottom of this consolidation, and what you'd like to see is a move sideways and then break up up above 45. You want to see the stock up here come back into this channel, and then we could redraw this channel and create a bit of a better looking uptrending channel. But that hasn't happened, so I'd be apprehensive about this rolling over here. And again, this is obviously indicative of a pretty direct corresponding to what crude is doing directly. So as crude has come off its highs in the last few days, you're seeing these stocks roll over. So be careful about that. I think crude can go higher, but if we're going to start to see lockdowns, people are going to start to sell crude because they have profits in it now, and we're going to see that dynamic also. And that means they're going to sell some of these companies, some of these oil companies, the majors, because if oil's coming back down, and I don't think it is, it's just a knee-jerk reaction. Sell the stock and look to try and buy it lower. So we're also talking again about retail traders and investors who are trying to buy oil company stocks on the cheap, and they're also maybe taking profits and are nervous. So just be a little careful in here. Long term, really for all these companies, it's really about who's going to be able to maintain their dividends. That's how I look at it. Okay, I want to talk a little bit before we say our goodbyes about options and using stops on options. And the question was, I don't recall the exact question, but it was really, do I use a percentage stop on my options? No, I don't. When I am in an options position, and I've said this many times, I have a very high tolerance for risk. So for me, a lot of the options plays, I'll ride them down to nothing. And that's not something I recommend for everybody, but I know what the risk is, and I'm willing to take it because I might even wait up. And there's many times I have waited until the day before or the day of expiration and made my money. So it happens. But I have generally an assumption and set of assumptions when I'm buying puts or calls. And I know I'm trying to buy, I'm trying not to go out too far and pay too much premium. So I'm trying to I'm expecting the stock to do what I want it to do within a time frame that I'm buying. So oftentimes, if I'm wrong, I will wait till the last minute and maybe lose 100% of my premium that I paid. As far as stops, what I do is I will I use a mental stop, not based on the options price. Some people, it's fine to use if you say, okay, I paid $1 for that option and I don't want to lose more than X, then they use that mental stop. Do not put down stop loss orders on options, please. You're going to get hit every time, or almost every time. And 99% of the time, you're going to watch the option and do what you wanted it to do. Use a mental stop. When you're ready to get out, just go put the order down and get out, okay? I know people want to put it in. Sometimes you're not around. If you have to, you have to. But give this option room to move, because you're going to need to. And even then, you will likely get hit. It's just the nature of how the mechanics of the market are set up now, and what high frequency trading people are doing, and how companies and shops are reading the order flow, and on and on and on. They know your stops are there. They're trying to hit them. Why? Because they want to buy down there from you. Okay, so you've been warned. What I like to do is I will look at the stock, the underlying stock. And for example, if I'm long calls, I don't look at, well, I bought those calls for $2 and I have X amount of time. Okay, I like the stock. I'm going to make up numbers. So the stock's at 20. I think the stock's going to go to 25 by the time my expiration, and my, say, at the money calls are going to have a nice 5-point move. Wow, okay, that's great. Give myself a limited amount of time for that to happen. And that's a big move on a $20 stock. So I'm obviously very optimistic about the stock, bought the calls. Let's just say I paid $2 for them. Now, I don't think, well, if I lose $1, or I should just exit with 50% loss. I will watch the stock. I will say, I have a good idea of where the stock has support, where I don't like it anymore. where maybe I was wrong about this, or something else has happened that's pulling the market down, and then on top of that, my stocks are coming down, and this stock is going to get hit or is getting hit. I will look at where I would exit the stock, where I think the stock is going to break down. So let's say it's 19. I will probably wait to sell my calls till I see the stock break through 19. So I will use the actual underlying stock. I will look at that, and that's where I trigger my get out of jail card. All right. So for me, if that stock drops to 19 or 1850, whatever my mark is, I'm like, I'm going to sell the options, because I don't think now the stock having broken down is not going to get back up 20. Certainly not get to 25. I don't think it's possible, but at that point, I'm probably out of the options, and I'll probably have a good loss there. But at that point, I'll be like, okay, that play doesn't work. So that's what I do. I prefer to use the action of the stock to consider where I will exit my options position. So hope that helps you. Again, and lastly on that, the reason I don't use percentages on the options, because they're not relevant. They're only relevant to you. So in other words, if you paid something for XYZ call or put, whatever percentage of whatever you paid means nothing to anybody. The only thing it means is percentage of your loss. That's all it means. It doesn't mean, because what you paid for the premium, it's relative to the implied volatility. It's relative to what the true, perhaps, so we call it the theoretical value of the option is. What's more important to me is the implied volatility. So percentages don't matter. They only matter to you in terms of, I only want to lose X percent. That's when they matter. So try using the stock and measure your exits based on the stock. And by the way, the same thing goes for the upside. I might have a profit target in, again, a call option. And if I really like the action in the stock, and if it happens a lot sooner than I thought, whatever I was imagining was going to happen, whatever I analyzed and expected to have happen, it's like, wow, this happened a lot sooner. And I still have in maybe another month or whatever it might have. I have a profit target in mind. I almost always do with my options. I may extend that and say, you know what, wow, this happened a lot sooner and I still have time. I will look at the stock. Oh my gosh, the stock broke out through resistance. Okay, I'm not going to sell the option. And I think I got another 30 days or 15 days, and that stock just broke out of resistance. I'm not going to take my profit. I'm going to try. Maybe I'll take half my profit because I don't want to lose it. But if I think the stock's broken out, again, based on the stock, and I've done that many times, only to get a lot more out of a trade than I initially had imagined I would. So there you go. A couple quick questions. Julian, thank you for your knowledge. My pleasure, sir. Anthony, is NVR a good home builder? Let's take a look. And again, for all of you out there, when somebody asks me, when any of you ask me about any company, I first look at the stock. I first look at the stock price, the stock action. I look at a chart. I want to see what the action of the stock is. And that's going to tell me right away a lot about how investors view this. Without me knowing what maybe the metrics are or having any idea if the company even makes money or what it does, I want to know what are investors doing with the stock? What are their expectations? So the quick read on this is, besides being a very expensive stock, NVR, everybody's NVR Inc., symbol NVR, trading at $3,192. And for a lot of you who are interested in a company like this, you can buy fractional shares now. So, if your brokerage account doesn't offer fractional shares, then maybe consider opening another brokerage account, because it's really nice to buy fractional shares. So if you bought a half a share in this for $1,500, $1,600, if NVR goes up 20%, you're still going to go up 20%. But maybe you couldn't afford to buy a whole share or 10 shares. So fractional shares are a huge plus. Looking at the stock price, Anthony, I like the action. The action looks really great on the stock. It was rising nicely before. It got hit obviously really hard, but it's certainly made a nice comeback, and it's created a nice uptrending channel for itself. You're trading really along the bottom of that uptrending trend line of the channel. Don't want to see a breakthrough there. I would say at 3,000, you've broken down, and maybe be a little bit consider then what you want to do. But right now, so far so good. Um, so they're a home builder, and I just don't understand why a home builder would let its price go that high, Anthony. So um, again, that to me doesn't make a lot of sense. Also, what's a problem is its volume is super thin. It's got 5,622 shares traded today. That may be relevant to the high price of the stock, but um, I'm always apprehensive about. I don't understand why a home builder would let their stock go up there, not split it many times over, make it more palatable. But again, I don't know the company. And for me, there are only a handful of reasons to let your stock rise to a price like that. And a home builder to me doesn't justify that. That's not justified. Um, just my thinking on that. So let's move on to a couple more questions, and I'll exit. Gap up gets filled. What about gaps down? Yes, they do get filled. Yeah, absolutely. Yes, Peter. Gaps get filled both on the upside and the downside. Yes. Anonymous, how does the oil sector Chevron look? Again, I think longer term, I like the oils. I like the oil companies. It's really about finding a place to get in, and I'm not comfortable right now thinking that we've hit bottom. We may have Chevron. You're asking about Chevron symbol CVX. Everybody, we're looking at it right now, and again, because some of these stocks look like they're rolling over, because is the market going to roll over? I don't see it rolling over. Some of them look a little scary. Chevron has done a tremendous job. The stock is really elevated stuff. It's come up beautifully, and I believe the CEO said they don't anticipate cutting the dividend, which is 5.81%. So yeah, I think certainly if you've got patience, I would hold on to it if I owned it. Certainly, if the yield is intact, if the dividend's intact, yeah, I would definitely hold on to it. I mean, I look at some of the other oils like Exxon. And and a lot of them, Total. I looked at BP earlier. I'm looking at a lot of them because I'm looking for places to maybe buy some call options on them, because I see the possibility of some good pops here and there. But in the case of Exxon, and some of them, the dividends are the dividend in Exxon is, let's pull this up for you, 7.76%. That's a huge dividend. Is it sustainable? Those are the kind of questions I have to ask, and I don't know. So Exxon, again, it looks okay. It's kind of trading in sideways action. I hope that's a consolidation. So I think the oils look okay, but they can make me nervous in a hurry. So just be careful about them. Again, if you got profits on stuff, you start to see it break down a little bit, and take your profit, and you can always get back in. Tom said, yes, Nikola is the new Tesla. They kind of go together, don't they? Nikola, Tesla. Yes, it is. Now, is there a lot of hype there? Yes, because people are looking at Nikola as the new Tesla. I mean, just because they took the name, Tesla's first name, doesn't mean that the company is going to do what Tesla has done in terms of the stock. Yes, the company makes electric trucks. That's exciting. They don't make any money. Their trucks aren't on the market. So long way to go before this company does anything, as far as I'm concerned. So been a lot of hype, a lot of Robinhood investors. Yeah, not knock you guys, but a lot of hype. So be real careful on that. If you got a big profit on that, I don't know, bank it. Bank it. I'm going to hit a few real quick ones. Michael, a minute ago, Exuberance Friday, oil stocks. We'll see. We'll see, Michael. And last but not least, Peter's saying MGP bought on the dip. So a quick look at MGP. Okay, MGM Growth Properties bought on the dip. Good for you. Certainly had a heck of a rise, heck of a yield. You know, PE is pretty high. Again, heck of a run. I don't know how much it can go, and I'd be a little careful on that. You come down to 25, and it gets below 25. I probably would take my profit and look for another entry to get back in case it dipped. But so far, so good. And last but not least, I see Chris had a question on opinion on DHT, DHT-TY. Let's take a look at that. DHT is DHT Holdings, but then you have a -TY there. So let's see what that is. Maybe it was a mistype. I don't see DHT-TY. Oh, it's thank you. Duh. Sorry, Chris. I'm a little slow sometimes. DHT. DHT, just terrible. It just all over the place. Pretty volatile, and it looks like it's broken down. So I'd be a little apprehensive about jumping on it, but it's certainly a fun stock to trade. I'm going to take a quick look at a couple little things on it. It just the action in that stock just scares me. Good trading stock. Again, you know, small market cap. It's I think about let's look up. I think it's less than $1 billion, if I'm not mistaken. Yeah, 759 million market cap. So yeah, a stock you can certainly ride up and down if you want to swing trade it. Long-term hold. It's got decent revenue and it makes money. That's all good. It's got a pretty sizable debt load, but it's got a reasonable operating cash flow. It does have a huge short position. That's where you're getting those swings from. You probably already know that. You got about 12.5% of float has been shorted, and hence the big swings. I don't love to see that because you got a heck of a dividend yield there, and according to, I'm looking at big charts over here, 14.29%, and the payout ratio, according to Yahoo, is beyond reasonable, 56%. So if they can maintain that dividend, then good luck. We got shares outstanding is 146 million times 140, and then the net available to common is 128. They're running real close, so that's not right. So that the payout ratio is not right there. It's a lot higher than that. So be careful on that one. Good trading stock, a lot of volatility. And if you're buying the dips and stuff comes out, earnings come out, and you got a good pop because of the huge short positions, you're going to have those kind of up days. So be careful out there with it, though. Hey, everybody. Thanks again. I'll catch you tomorrow on the way out. The Dow's holding up plus 50 points. And 10-year, I like to keep a good eye on the 10-year, especially when we have a sell-off like we did yesterday. 10-year went down from about 0.71 to 0.67. It's certainly a move that was expected, but not a big move. And it's holding down there today, I think. Let's just see. VIX has come off a little bit. We're down to 33 and change. S&P is up. Dow's up a little bit. NASDAQ is up the most. And the Russell, of course, up more than that because that's where the Russell's trading these days. 10 years is still at 6.67. So so far, so good. Not a bad day on the heels of yesterday when people got a little nervous. I didn't because there wasn't a lot of volume. There wasn't a lot of conviction on the selling. And the playbook, coronavirus crisis playbook, we know. We know how to play it. It's happened already. We've lived through it. I don't think anything's going to change next time around, except everyone knows we're going to have to lock down faster, and we're going to have to give up those lockdowns sooner because people need to work. So we know that. So with that, I bid you a fond farewell, and I'll catch you all tomorrow. Be safe out there.